Welcome to HustleMind, where smart money minds are made. This is part 2 of learning about important wealth-building financial rules that are not taught to most young working adults when they are just starting out. These are stuff I wished I knew 10-15 years ago when I started out on my own financial journey. Having these knowledge will fast-track your path to financial freedom and let you avoid the common mistakes that people make when building wealth. This is one of my favorite, the Rule of 69.3. This rule is a more precise version of the Rule of 72, specifically designed for continuous compounding rather than discrete compounding. Divide 69.3 by your rate of return to find your doubling time, great for advanced investors. Most traditional investments compound periodically like monthly, quarterly, or yearly, but continuous compounding assumes that your investment compounds every instant of time. Mathematically, it's the most efficient way money can grow. In real life, most banks and investment platforms compound monthly or yearly, so the Rule of 72 is usually good enough. But in theory-heavy finance, algorithmic trading, or high-frequency investment models, continuous compounding is used for modeling growth at the micro level. It's often applied in advanced finance, options pricing like the Black-Scholes model, and bond math. Next up is the Rule of 70 for calculating inflation impact. Want to know how fast inflation eats your money and erodes your purchasing power? You can use this rule to calculate the duration it takes for inflation to cut your money's purchasing power in half. It flips the same logic used in the Rule of 72 for doubling investments. But instead it reveals how fast your money is losing value over time due to inflation. The calculation is simple. Just divide 70 by the inflation rate. At 4%, your money loses half its value in 17.5 years. It shows why saving money under your mattress or in a low-yield bank account is dangerous. Your money needs to grow at a rate higher than inflation just to preserve its value. If you're not investing, you're essentially losing money slowly every year. So how should you protect yourself from inflation? You can invest in assets that outpace inflation. Examples of such assets are stocks, index funds, ETFs, real estate, and commodities like gold. Another way is to build income streams that adjust with inflation, like rent or royalties. Next, we have the Rule of 144. It estimates the number of years it will take to quadruple your investment at a given annual interest rate. So why 144? Because it is derived from doubling your money twice. Since the Rule of 72 helps estimate one doubling, doubling it again is equivalent to quadrupling. So it is essentially 72 plus 72, which is how we arrive at 144. So if you're earning 8% annually, your investment will quadruple in 18 years. This rule helps you to set long-term expectations for investment growth and lets you compare investment vehicles based on how fast they multiply wealth. It also showcases the power of compounding over decades and not just short-term growth. The fourth rule we have here is the 10-5-3 rule. This is a simple financial rule of thumb used to set realistic expectations for long-term investment returns across different asset classes. This rule states that on average, over the long term, stocks have an expected return of 10%. For bonds, it is 5%, and cash savings like money market and bank savings accounts is 3%. It lets you estimate how much you can expect from your investment and prevent overestimating returns, which could lead to undersaving. It encourages you to invest in higher growth assets like stocks to beat inflation and grow wealth. However, do take note that these are long-term averages, not guaranteed every year. Inflation, fees, and market conditions can still impact real returns. Therefore, diversification and risk tolerance still matter. Don't invest in stocks expecting 10% every single year. Rule number 5, the 50-30-20 rule. This is one of the most popular budgeting methods, simple, effective, and flexible, especially for beginners who want to manage their money wisely without feeling overwhelmed. It breaks down your after-tax income into 3 spending categories: needs, wants, and savings. Needs are your non-negotiable, essential living expenses. They are things like rent or mortgage, utilities bills, water, groceries, insurance, transportation, and minimum loan payments. If this takes more than 50%, you may need to cut back elsewhere. Next are your wants. These are things you enjoy but could live without. It includes things like dining out, Netflix and Spotify subscriptions, shopping, fashion, traveling for leisure, personal entertainment, hobbies, and also upgrading your tech gadgets. Spending here isn't bad, but keeping it under 30% helps you stay balanced. And the remaining 20% is your savings. This is where real wealth building happens. It includes building your emergency funds, your retirement savings, and investments. This is the category that helps you achieve financial freedom. This rule is easy to apply and keeps your financial life organized and intentional. It encourages regular saving without being too restrictive and helps prevent overspending on lifestyle. Okay, next we have the 1% rule for real estate investing. The 1% rule is a quick and powerful rule of thumb used by real estate investors to screen rental properties for cash flow potential, especially when you're analyzing multiple deals. So how do we apply this rule? To put it in simple terms, a property is worth considering if the monthly rent is at least 1% of the purchase price. If a property costs $200,000, the monthly rent has to be at least $2,000 to meet the 1% rule. So that means you should only consider this property if it can reasonably rent for $2,000 a month or more. This acts as a quick filter to help you identify positive cash flow properties, avoid overpaying on low rental property, and lets you compare multiple properties efficiently. While the 1% rule is useful, it is just the starting point, and not the whole story. A deeper cash flow analysis is always needed, but the 1% rule is great for quick deal screening. A good way to use this rule is to immediately rule out properties that don't meet 1% when browsing listings and focus your energy on deals that pass the 1% test, then run full financials. Rule number 7, we have the latte factor. It is a simple but powerful financial concept that shows how small daily expenses add up to big money over time. It's not really about coffee, it's about mindless spending that slowly erodes your ability to save and invest. Coined by David Bach in his best-selling personal finance books like The Automatic Millionaire, the latte factor refers to the small purchases we make regularly: coffee, snacks, subscriptions, eating out, that seem harmless but add up significantly over time. Let's say you spend $5 a day on a fancy coffee or snack. $5 a day over 30 days is $150 a month, $1,800 a year. Now add it up across 20 years with a 7% annual investment return, that's $72,000. $72,000 from just coffee. Now imagine if you had multiple latte factors. Streaming services, Uber Eats, gym memberships you never use, daily vending machine snacks, cigarettes. It really adds up. It's not about depriving yourself, but about being aware of small, habitual spending and the opportunity cost of those expenses. It's not saying you shouldn't enjoy life, it's asking, is this $5 truly bringing me joy, or moving me toward my goals? Or could that money be better used? The goal is conscious spending, not guilt. You can consider redirecting that money into investments or savings instead. Redirecting just $10 per day into an investment with compound interest could help you pay off debt faster, retire years earlier, and build a six-figure portfolio effortlessly. Now, this is a rule that most people have heard of, the 80-20 rule, also known as the Pareto principle. It is one of the most powerful mental models you can apply to money, business, productivity, and life. The 80-20 rule states that 80% of outcomes come from 20% of inputs. It was first observed by Italian economist Vilfredo Pareto in the 1890s, who found that 80% of Italy's land was owned by 20% of the population. Since then, it's been observed in everything from business profits to time management. Some examples are, 80% of your unnecessary expenses come from 20% of your habits, or 80% of your income might come from 20% of your skills or clients. 80% of gains might come from 20% of your investments. 80% of your problems come from 20% of your habits or decisions. Since 80% of your results come from 20% of your efforts, focusing your time and money on the most impactful 20% allows you to grow faster and reduce waste. For example, if you audit your spending, you might find that a few categories, like dining out or subscriptions, make up the bulk of your non-essential spending. You can cut or optimize those and you instantly improve your financial health. Or if you're building a business, you may notice that 20% of your efforts, like your best performing offer or marketing channel, could be generating 80% of revenue. Last but not least, we have the rule of 25, which is very closely related to the 4% rule. The Rule of 25 is a core principle behind the FIRE movement, which stands for Financial Independence, Retire Early. It helps you figure out how much money you need to retire and never run out of money. To know how much you need to retire, just multiply your annual expenses by 25. This formula estimates how much money you need invested to live off your portfolio indefinitely. If you can live on $40,000 per year, you need about $1 million invested to retire comfortably, assuming you are also following the 4% rule. I have a full video explaining the 4% rule, so I won't be going into too much details here. You can find the link to that video in the description below. These rules are the ultimate wealth-building toolkit. Apply them, and financial freedom becomes not just possible, but predictable. Like, subscribe, and share this video if you found value. And if you want to support HustleMind, you can buy me a coffee using the link in the description below. Thanks for watching. Remember, hustle smart and grow wealthy.